Ah, Good evening, ladies and gentlemen. Welcome to the Rates and Lanes podcast. I'm your host, Rico Muhammad. I will be joined shortly by my co-host, Mr. Chuck Snow. And tonight we're talking insurance. So if you got questions, concerns about anything truck insurance related, we have the professional guest on board tonight that can help answer any questions that you might have when it pertains to truck insurance, cargo insurance, anything of that nature. We might be able to tackle any and all of your insurance questions. So type it in the chat, and we'll get to you as quickly as we possibly can. We'll get to your question and highlight it and bring it up and on board as quickly as we can. But without any further ado, this week's trend lines reports from DAT, we're showing that the average price of diesel fuel is still kind of just hanging out. It increased by 0.3 percentage points, showing that the national average price for diesel fuel is sitting at $5.72 per gallon. Reefer line haul spot rates headed in the opposite direction. We're showing that just 2 weeks out from the normal peak in the produce volumes over the July 4th weekend, reefer rates decreased again last week. Even though produce volumes have increased by 5% last week, the weekly truckload volume of produce is down close to about 18% year over year, according to the latest USDA data. That's the equivalent of over 34,000 fewer truckloads of produce moved last week compared to the previous year. Reefer line haul spot market rates dropped last week by just over a penny per mile to the national average of $2.24 per mile, including fuel, or $2.98. That $2.24 per mile excluding fuel. It's with the fuel surcharge added into it, it's sitting at right about $2.99 per mile on average on the spot market. So without any further ado, and let me do it this way. I want to try to get in here and share my screen with you guys. Here we go. Let's see if this works. I wanted to share the screen showing the national average prices for dry van rates across the country. We're showing that up in that upper northeastern corridor, that average outbound spot market rate checks in at $2.44 per mile for dry vans. Moving down to the mid-Atlantic and southeastern portion of the United States, we're showing that average rate comes in at about $2.80 per mile for dry vans. Moving up into the Midwest, we're showing that the average outbound spot market rate checks in at $2.78. Coming out of the South Central region of the United States, we're showing that the average outbound spot market rate is at $2.74. And moving out of the West Coast, we're showing an average outbound rate for dry vans at $2.63. Shifting gears and jumping over to the flatbed portion of the DAT report, we're showing that a national average coming out of the northeastern corridor for flatbeds checks in at $3.36. Moving down to the mid-Atlantic and southeastern states, we're showing an average outbound rate of $3.77. Moving up into the Midwest, we're showing that average outbound rate checks in at $3.64. Moving back down to the South Central region, we're showing an average outbound rate for flatbeds at $3.46. And coming out of the West Coast, we're showing an average outbound rate of $2.97. Shifting gears, jumping over to temperature control reefer, which we were just kind of alluding to in the previous portion of the report. Coming out of the upper northeastern corridor, that average outbound rate for reefers is at $2.62. Coming out of the mid-Atlantic and southeastern portion of the United States, that rate is at $3.08. Moving out of the Midwest, we're showing an average rate of $3.14 per mile. Coming out of the South Central region, leading the nation, we're showing an average outbound rate of $3.16 for reefers. And wrapping up, coming out of the West Coast, we're showing an average outbound rate of $3.10 per mile. And with that being said, ladies and gentlemen, I can stop sharing my screen now. And I'm going to welcome my co-host up and on board, Mr. Chuck Snow. Good evening, Chuck. How are you?
We're doing well. How are you, Rico?
Doing great. I really can't complain. Looking forward to tonight's show. I think it's going to be I got a couple of topics in mind that I want to make sure that we try to get a chance to discuss, but I'm always interested to see what our listeners and people that are checking in see what they may have that they want to talk about as well.
Well, you know what? Somebody asked me, and we'll bring Tommy and John on because I was talking to someone today, and they said find out about something. So I want to bring it up to both of them. So with no further ado, how about we bring them on?
All right. Well, we got Mr. Tommy Root. Tommy, good evening. How are you?
I'm fine. John will be here with us in a minute. He had to take care of we're doing a class here, and we took some of the speakers out to dinner, so I ran over here while he has to pay the bill. So I'm waiting for him, but he'll send that. So we'll wing it without him for a little while, guys. I'm glad to see you all. This here is the first one of these kind of experiences, although we've been virtually teaching all week. I've had 30 people in front of me for the last week and a half. I got about 12 people here in the room with me. So we've been talking trucking now since Monday morning at 8 o'clock.
Okay, good deal. Well, I'm glad to have you backing up and on board with us, Tommy. It's been a little while. Everything has been going good since the last time we spoke.
I am doing very well. Everything's growing well. My grandkids, I had a birthday a couple of weeks ago, and I had South Carolina. I got about 9 of my grandkids together for that, and we celebrated one college graduation, one high school graduation. You can't ask for more than that, particularly since the college graduate already got a job that pays more than I ever made in my life. So in 1 year. So the only problem with it, no disrespect for our listeners, but she has to live in Birmingham, Alabama. She graduated from Birmingham. That's the only downside to it. She's going to be an Alabamian.
Right. I'll tell you what. Well, Chuck, you said you had something that you wanted to get into.
Tom, I just wanted your opinion on this. I was talking to a carrier today, and he's not available to come on the show, but he asked me to ask you, are you seeing a huge increase in insurance rates because of the cost of replacing not just equipment, but even if somebody hits a car? Cars have gone crazy. Used cars, I've heard stories where somebody bought a car a year ago for $41,000 and had it stolen or written off, and it's now $57,000. So what are you seeing as far as insurance rates?
Well, the thing you have to truck is not rates, it's premium. Two things you mentioned here. That's the value of the truck itself. Right. If anybody's listening to us, and we talked about this before, if anybody's listening to us, they got to reevaluate your trucks. 90% of the policies that are written for long-haul 18-wheelers are on something called a stated amount, which the limit is a function of the premium, but it's also all you can collect. Right now, if you bought a policy 6 months ago and you haven't adjusted your problem, you're probably uninsured by 50%. So you need to look at it. I was on a competing show, the Road Dog Radio Channel 146, as you know, here, and we had.
I'm honored that you'd call that a competing show, but thank you.
Well, what I'm saying, I'm competing talking to truckers. Let's put it that way. Okay. And we had one called in and said, "I heard you last month, and I just went and I had insured for $38,000. I just went and found out what it was worth. It was worth $65,000." Wow. So they're going to have to now insure for $65,000, which Chuck makes the premium higher, but not the rate. In fact, when you get that high, the rate per 100 of coverage per 1,000 coverage is actually a little less pure rate, but the exposure is higher.
Right.
Part of it. So that's the problem. As far as and the problem you have, and this is something they got to understand, they got a greater chance of being put out of business because of a physical damage loss where their truck's undervalued than a nuclear verdict, because they're going to survive a nuclear verdict, these smaller truckers, because of the way it's going to be handled, but they cannot survive that truck being taken away from them. And that's the problem you have, because if you only have $38,000, what the insurance company can do is write a check for $38,000 and take the salvage and sell it for $40,000 and recover to $38,000.
So they haven't lost some money.
This is the way it works. So that's the real danger. Now, even though the autos are high, Chuck, the idea that the auto liability rate, because you're talking about two different rates now, right? I talked about physical damage. The rate's not up, but the premium should be up because the values need to be increased, okay? The second part about it is that the auto liability, the cars are worth more than that, this part. But in the big scheme of things, a increase of $20,000 to pay for a car isn't going to affect the premiums. I mean, it's not enough dollars
No, but if insurance companies keep losing, like every time that a truck hits a car and it's an extra $10,000 or $20,000, they're in business to try to make money. I know they haven't made a lot lately, so their loss becomes that much greater.
That's not going to affect the rate anyway. They're going to write a check, walk away from it. What affects the rate when you got a lot of people in it and you're defending liability, and you have to have lawyers to defend it, who's negligent or not, and things like that. I mean, that's not a car injury is not going to affect rate significantly at all. This part, a cubic lead down the line, maybe, but that's not what drives auto liability rates. It's the bigger checks. I mean, this is what you pay us to do these kind of things, because that's a predictable claim. All I got to do is go in the blue book, find out what it's worth, and write a check for it and take the salvage. We don't have to pay legal fees. We don't have to pay defense or anything. Excuse me. It's the passengers in that vehicle that could cause the problem. But the one thing that you didn't ask me about that they need to be considered about is cargo.
We were getting on that one.
Now what's happening is the cargo they're hauling is worth 30 or 40% more. And some of the brokers are still saying all we need is $100,000 worth of coverage. And now they're hauling a load worth $180,000 and all they get $100,000, but they're responsible for the full $180,000, even though the broker only requires $100,000. And so this is the concern they have, that then that's the thing that could affect their business. Again, the cargo is not significant. Rate increase is up. There's not any rate increase, but again, they get the cargo they're hauling is worth more than it used to. And I'm not sure, Chuck, this, the brokerage industry, 3PL industry better than me, but I'm not sure they've adapted the increasing that value. And a lot of brokers, as you know, don't know what those loads are worth.
They have no idea. You know what? There are brokers out there that don't even know what the heck the product is, never mind what they're worth.
Right. And so that's the real danger. Your insurers are responsible for the payment of it, even though they don't have enough insurance, and even though the customer only requires, or quote, the broker only requires $100,000 worth of coverage. So this is where the runaway problem is. But again, I want to emphasize, it's not rate, it's they need more coverage.
Right.
So the rate they're paying for the coverage is going to be percentage-wise maybe slightly less, because again, there's a volume situation where the more you buy, the less per 100 you buy.
It's a premium that's going to go up.
And so the premium's going up. It's not the rate. So to separate those two, yes. But
so tell me something. Your average carrier that is running the spot market, where he doesn't know who he's hauling for, what do you think is the number he should be going at these days in order to protect himself or herself? Do you think they need $250,000 in cargo liability?
A couple things. We talked about this today, and I actually had a interesting chain of emails with our friend Chuck. I mean, our friend Hank, just this week on this very subject. They need to know they need to be careful what they're hauling and what it is worth, and they need to take a minute and find out about it. But more important, how they're going to protect themselves is they need a tariff. And in that tariff, they got to have the wording, and we talked about this for the agents today. I'm not going to be responsible for more than what you require me to have. That creates a release bill of lading part of it. And so that's what they need to increase it to 250, I think, Chuck, in this marketplace, almost anything. I mean, even a load of razor blades are worth $250,000.
Oh, easy, all day long.
Yeah, in today's market. So they don't ever have to run into that. So even though the broker might require $100,000, they need $250 to cover their potential for most things that they're hauling. But if they have that tariff involved in it, what came up in our discussion today, because we talked about cargo this morning with someone that had been with Chubb for 30 years. And what the broker will say is, don't worry about the limit. I got coverage above that. Well, what the broker, and this is what Hank and I had discussion is, the broker is buying something, the shipper's interest policy. And most shippers have coverage on their own goods. Here, And so that's what. But the problem is those shipper interest policies have the rights now to go back against the trucker to collect what they paid.
Right.
So unless they have that involved, or what Hank suggested is for the trucker to ask for a waiver of subrogation in that shipper's interest policy in their favor. But it's a smaller trucker is not going to, is going to be tough to do that. So
Here's
my
what you do.
suggestion,
that you know what, that works great in the office when you're dealing with, you know, when a carrier is dealing directly with the
shipper,
or even a broker is working directly with the customer. What in the real world, Tommy, as you know, a small carrier, 1 or 2 trucks or 5 trucks, whatever, sends a driver in on a spot rate load to go pick up a load of widgets at a plant in Birmingham, Alabama, going to New York City. And if the driver starts asking for anything special, they'll just tell him to leave.
Right. Well,
you know,
today with short of truckers, they might be a little more patient, but that's the thing. But what they might need to do, even absence of a tariff, if they could put some notation on it that for what you're paying me, all I'm going to be responsible for is $100,000. If they put that kind of notation, even though it's contract away, Carmack and other things, I've talked to Rob Mosley's office, and they have argued that because you're not paying me more for this, I'm only responsible for that $100,000. So if they can come up with some verbiage, even a rubber stamp that they put there, and most brokers will not give them a low because this is they still got 100,000. So there's nothing they have to sign and agree. Then later we could argue with them is that becomes a release bill of lading because we would have charged more for you if you had required us to have 250. So
right.
That's the way that would suggest some way to get out of it, to say all I am going to be responsible for is what you haul, what you require me to have for what you're paying me. That's what we need, the message they need to get out.
You remember the old days, Tommy? And they still do it with the big LTL guys do with the class system, and you had freight classification numbers.
Well, for the value, that creates the release bill of lading, which
exactly.
And the U.S. is the Carmack Amendment. I think there's another amendment in Canada that parallels the cargo liability.
Well, ours is anything that ships domestically or ships out of Canada to the U.S. is automatically $2 a pound unless otherwise agreed and specified on the bill of lading.
Right. So, and that's the kind of thing, same thing in U.S. for moving and storage, $1.35 a pound. But yeah, those things there, but not for general commodities. That's the problem we have. But that's kind of stuff we've got to bring back into it in that way. And Chuck, I think that latter discussion, a rubber stamp or make that comment will pass the mustard of a broker because, as you said, all they want is a load haul. They're not going to pay attention to what that necessarily what that comment says.
I'm not even going to put it on brokers that just want the load haul. I mean, most carriers don't really read or know what it is that they're getting themselves signed up for, because most carriers don't even read the broker packet.
You're right.
They don't understand. They don't fully understand or grasp the levity of what it is that they're signing when they're signing away all of their rights without even questioning what's going on in most of these broker contracts. They just basically rubber stamp it and keep it moving. They're trying to get revenue on the truck and keep keep the wheels turning and hopefully keep the money coming in.
Amen. So that's the only why, if they take the time and talk to a good transportation attorney to draft some tariff or something, or even get a rubber stamp like I suggest to it, just to stamp it here.
Tommy, I agree wholeheartedly with you, but what my fear is that the truck owner gets out of the truck with a stamp. He's signing the bill of lading. He stamps it. You have to have somebody sign the stamp, do you not? Or is it legal
No, as long as it's on his receipt, and they have, because they got to come out and prove that bill of lading in the case here. Chuck, I'm not saying it's going to win all the time, but at least we have something to argue about now.
Yeah, of course.
I tell you what, that'll be a good discussion to have with Hank along with that definitely is a good discussion.
Everything we just said, I wrote Hank about, and I also told him I agree with him about the waiver, but the waiver is harder to get because that's got to come from the insurance company. Right. Whereas all this has to be is just to go back into the release bill of lading value concept that is respected in the industry. That's the only difference where he and I differ.
I really do think that it's very, very important for any carrier. If the broker doesn't know what you're hauling, then you have, as a carrier, it's your responsibility to find out what you're hauling. Because we've heard horror stories of carriers pulling up and getting, loads of, hazardous loads, and the shipper didn't even gave him no documentation or placards or anything.
Right. And even though you don't formalize it, if we can just prove later that a standard thing is it worth more than this? Something that says this, because at least we have an argument back and the courts would be sympathetic for it. They ask you if it's worth more than that. You said it was not. So why should they expect to be responsible for more than that? And trying to get a quid pro quo, meaning this is all you're paying me and this is all I'm going to be responsible for is that amount. John just walked in the room here. We'll bring him here in a minute, but go ahead, Carl.
Well, Rico had a real good one.
Cargo about the release bill of lading and the shipper not knowing what the value's worth. It's a discussion we have now. But anyway, I don't. It's an answer. It's not an answer, Rico. But that's the best that we can talk about think about right now. But this is a major thing with the commodities, both trucks and cargo, so ungraspably more valuable than ever before. This is a real problem now, and there's a chance this could put them out of business.
Oh yeah.
Well, kind of changing gears just a little bit. I've got a lot of people that I've been talking to, and a lot of people on social media as well. The topic of adjusting your insurance rate. Like right now, we talked about the cost of everything going up, used truck markets and everything else. And I was talking to a gentleman who has not contacted his insurance agent about changing the value of his truck. He still kind of got it set at where when he first got his insurance from his renewal standpoint. So he hasn't adjusted the value of his truck to match the market conditions right now. He was under the assumption that if something were to happen, that the insurance company would go back and pay off the true value of what the truck is worth, not what he has it insured for. And I tried to explain to him, from my understanding, that definitely is not the case. So I'm gonna throw that over to you, gentlemen, if you can kind of peel back the layers of that onion a little bit.
Okay, let's talk about two things. Let's talk about typical auto physical damage coverage. That is absolutely true, that his assumption for your car, because your car is not based on a stated amount, it's based on the cost new. And a lot of the commercial policies, riding pickups and vans and all, are based on that, but not the trucking arena, not the 18-wheel arena. 18-wheel arena uses a product that says it's called stated amount. It says you tell us the limit of coverage, and that's the most we're going to pay. It's not what we're going to pay, it's the most we're going to pay. So we're going to pay ACV what it's worth, or the limit, whichever is the less. So the case of trucking, and 9 times out of 10, that's going to be a provision, and he's wrong about that. All we're going to pay is that limit, period. And the part of that is, and that gives the carrier the opportunity to declare it a total loss by paying a limit and taking a salvage. That's the right they have involved in that, because that's all that they will owe on it. And then they will keep the salvage again and recover some of their costs, Rico. That's the problem we have today. So he's not right about trucking. He is right about car insurance and small commercial, but not trucking physical damage coverage for most of the policies out there.
Actually, if you look at the motor carrier coverage form, the insured is right as the form is written.
Right.
But it is the stated amount endorsement, and the stated amount endorsement for motor carriers for the risks that we see, that you teach about, that all the students of MCIF insure, is probably on 95% of the insurance policies. It's one of the most dominant standard coverage endorsements that relates to the commercial trucking industry.
Right, Cole, let me bring two things. There's a couple of insurance companies who actually modified their coverage form that says that than an endorsement. But this is, physical damage coverage, and without getting too much in the weeds, insurance is property coverage. Every property policy you have for your buildings, for your contents, for your forklifts, for your cranes, are all written exactly like this. The most we're going to pay is ACV or the limit, period. The only thing that the ISO who's written it, where they came up with this original cost new when there's no limit on it. That's unique to property coverage. What you have now with stated amount is the true property coverage that says all we have involved in that. And the problem, Rico, if you really want to get into the weeds, you not only got the values going up, but you don't have any coverage in 70% of these for the tow bill. Because all they're going to pay a limit is for the repair, replace, and tow bill is going to have to be paid out of that limit. Now, there's some insurance companies will pay in addition to the bill, the tow bill, in addition to the limit. Some will not. That's something they need to ask their agent. They need to ask their agent, if I have a high tow bill, will you pay it in addition to my limit?
Well, what we've got right now is actually, in my adult life, almost perfect storm that I've never seen before. And so here's, you can ask any of your listeners, when's the last time that a vehicle, as you're using it, went up in value? It just doesn't happen.
In a long time.
It doesn't happen. And then tell me the last time that we had really significant inflation in our country. And then related to the first point, what's the availability of replacements? The value of the used equipment is obviously impacted on an upward basis because of the lack of the ability to purchase something new. But what that means is that the insurance industry and the trucking industry dominantly would never have the thought, I need to look at the values of my equipment and change them midterm. It's simply something we've never done.
Usually it's the other way around. Now, the question you have here from Stephen, why is the insurance able to get away with not paying the full drag? Because that's what the contract that you accept from them says.
The limit is the limit is the limit.
That's why
the answer.
That's what the policy says they're responsible for.
Gotta read the fine print, ladies and gentlemen.
Well, not only that, Rico.
It's the insured set the value.
Right.
The insured chose the value for the property.
Right.
The insurance company doesn't say, and if an insurance company did, they're dead wrong to say this is what you should insure the property for. It's the insured that chose his value.
Rico, let me ask you this question. Do you own a house?
Absolutely.
Do you think your house is worth more than what it's insured for?
Definitely.
So if that house got burned down, all you're going to get is what?
All I'm going to get is what it's insured for. But
right. The same thing here.
Responsibility is on us to make sure that we're staying on top of the market and understanding what it is that we have. I mean, at the end of the day, you have to look out for your own best interests.
Right.
And that's one of the reasons why we do the show. We try to keep people informed to let people know that, hey, don't let this slip by the cracks, because if something happens, we don't want it to be we want you to be proactive. We don't want you to get caught with your pants around your ankles and you don't have anything any other course of action left available to you than what the only options that they're giving you. So if you can stay ahead of it, as my granddaddy used to say, son, if you stay ready, you ain't got to get ready.
and Rocco, the only thing I want to write back to is to go back to Stephen. Stephen only paid the insurance company to be responsible for X dollars. So why should they be responsible for more than that? Same thing with the homeowners that they have here. And that's what they got to relate to, part of it. And
I think one of the biggest misconceptions I think that we have in this industry, gentlemen, is that for most people, the smaller guys that are in this industry, 1 and 2 truck operators, or maybe even a small fleet, salt of the earth people don't really have not really all that sophisticated from the standpoint of thinking about things from I'm going to say a sophisticated business standpoint, where instead of them thinking upon things of being more adversarial, so to speak, I think that we think of things of just kind of, this is the right thing, this is what should happen. I think we come at it from a consumer mindset, whereas in business, that there's nobody's lookout. It's your responsibility to look out for your own personal interest. That's why the contracts, they're bilateral contracts, they go both ways. But if you agree to what's on one side of the contract, if it's a one-sided contract, but you agreed to it, then that's, you made that bed, you got to lie in it, so to speak.
Rico, let me add one other thing in this, and Chuck, and I think John, if their insurance agent has not warned them in the last month that they need to look at the value of the trucks and make sure and adjust their physical damage, they got the wrong insurance agent. John and I have preached on emails, on webinars, even today, that they've got to contact their insurance. And so if that agent's not doing that, in my opinion, John, they got the wrong agent. I don't know how you feel about that.
Well, the problem is the issue doesn't arise unless it's a serious loss. If you have a tractor insured for $100,000 and there's a $25,000 loss that occurs, that's a serious repair to the unit. The insurance company is going to pay that, even though the value of the truck may have increased to $150,000.
Right.
So it's only when there's a serious loss. In other words, it's only when there's big money.
Right.
So the problem is the issue arises when it's a lot of cash, when there's a big discrepancy of dollars. In insurance, if the unit's insured for $120,000 and a replacement can be found for $121,000, I'll just give that example. Right. What do you think the insurance company is going to do? They're going to get the replacement units because it's not worth $1,000 to argue over the last $1,000 in the $120,000 example. Right. If to replace the unit costs $150,000 and the unit's insured for $100,000, the insured is absolutely, completely, totally out of the $50,000. More so, the most common thing that has occurred in trucking insurance with regard to the insuring of high valued equipment, when I say high valued, I'm talking about extra heavy truck tractors over my adult lifetime, is the most common way that equipment is insured is somebody looks at what they owe. They say, well, I owe $70,000. So I guess that's the least I should insure it for.
Right.
And that's wrong. Of course, that doesn't have anything to do with the value of the piece of equipment. But in a period of life where depreciation is a big factor, it's not nearly, we're in the exact opposite environment. So insuring something for less than it's worth is exasperated because we've done that as a society and gotten away with it more often than not. Not today, though.
Rocco, to this wrap up what John said, that up until about 6 or 8 months ago, the average physical damage truck was overinsured because, as John said, they insured what was owed on it, and it was probably worth
less than they were probably underwater
of that part of it. It's only in the recent year and a half to 2 years that this has turned upside down. 2 years from now, this won't be a discussion. It's going to set back out once chips are here and things now get back in the marketplace. So it's an anomaly we're dealing with right now. Just like you just give the race, Rocco. Where in the world have we gotten $3 a mile to flatbed hauler? I mean, when in a lifetime? Well, and I'm sure a couple of weeks ago, and we were paying $5 a mile for a reefer operation. I mean, that's also the anomaly in that part of it.
Yeah, but you know what? The reefer haulers may be getting $3 and change a mile, but they're paying $5 and change a gallon of fuel. They've never paid that either. And I think there's going to be a lot of turmoil.
Right.
You know, the thing that you have, we tracked. I just did a survey where how many new ventures, which last year there were more new ventures than ever, are still in business 18 months later.
Yep.
And it's less than 50% of it. Excuse me, still have an insurance filing. It's less than 50%. So in March, we had more cancel authority revoked for no insurance in history, as last year we had more new ventures than ever before in history. I mean, these are just really strange times.
I'm really expecting that
the
number
truck
to continue.
they went under lease to a carrier.
Yeah,
they couldn't make a go on their own.
Right.
But there's a lot of turmoil. I mean,
I'm expecting that number to go
been a
up.
time when so many numbers down at the same time.
Never.
What
Not
you're
like this.
paying for fuel, what it costs to move freight, what the truck is worth, what the load is worth. These are all all of the answers to those questions are way outside the norm, and they're big numbers.
Interesting times indeed, gentlemen. Tommy, did you get the text message that I sent you, or the picture that I sent over to you?
That contract.
Yeah,
well,
I think we should put that. Can you share that with our listeners?
Somewhat. I'm going to share my screen. I'm going to share my screen right now. Hold on a second.
I'm asking you: is this a shipper and broker agreement and carrier agreement?
This was at a shipper, according to the person that shared this. This is what they arrived at a shipper, and this is what the shipper put this out that they had to sign, and it was quite interesting. I knew that we were going to have you guys on, and I know we're going to have Hank Seaton on here shortly. And I figured, since we were having you gentlemen on, I'd throw this across and let you guys take a stab at it along with Hank, and just see what your thoughts are about this whole little thing. Well,
again, we can't. You're going to have to make the size a little bigger here. I just read it, and basically what it says is that this shipper, and again, the thing I would question in this is the way I read this. It's an agreement to load and unload. I'm not sure it's a shipper motor carrier contract more than a lumper contract. Thing I would want to question about this, Rico, what kind of coverage will be coming in place, because it's unloaded by a forklift, then it'd be a general loading and unload by forklift, versus if it's a claim, it would be auto coverage. So this thing, but they're got to hold the whole world for anything the damage is. Okay, that's what basically says. And in far as insurance goes, the three concerns I talked to Hank about it. I don't, because it's a kind of a hybrid. There is state laws in every state but four, and I could name them four to tell you. I keep forgetting them. That a contract where a shipper requires a trucker to hold them harmless is against public policy. It's not enforceable. It's the anti-indemnification contracts in every state except four. And so if this contract is any one of the state but four, and it is interpreted as a shipper broker contract that falls under that contract, it would not be enforceable. Not enforceable. And so the part about it, if it is enforceable, this might be covered by general liability insurance, contractual coverage, unless there's an exclusion to coverage away. Part of it, because the insured contract includes when your trucker agrees to hold a shipper harmless for the shipper's negligence, that is covered under general liability policies unless there's endorsement added to it to take it away. It's covered under all liability policies if it was involved in an auto case. Part of it. But it's one that you would hope they would not have to sign. So I'm not sure exactly the services that they're offering, where if they're loaded their own trucks or not, Rico, because of the title, and it was involving actions arising out of loading and unloading, not actions arising out of moving freight. That would be the question I would have.
Got you. I don't even know. I don't know. My opinion, I would probably be leery about signing anything.
I wouldn't want to sign it. I'm not telling you to sign it. I'm telling you how the insurance would look at it and why it might or might not be enforceable. Fair enough here. I wouldn't want to sign it either. I think you're crazy to sign it, particularly this marketplace here.
Yeah, I cannot imagine that the shipper could have the leverage over their carriers for an agreement that's onerous in this environment. I can certainly imagine that an attorney somewhere said, "Hey, let's see if we can get folks to sign this." And usually what I've found is that there is a story behind, I'll read it later. I can't see it without my glasses.
Okay. I was going to show them.
There's a story behind these sorts of documents that relates to an event that has occurred. And so the documents are reaction to the event. But without knowing that history, that's just conjecture.
Right. And unfortunately, you know, I've personally ran into situations at a shipper where if the shipment was loaded onto the truck. I'm signing ready to go. I'm signing the bill of lading, and I'm putting on the bill of lading. I'm noting that my company name on the bill of lading is the carrier of record. The shipping clerk got upset with me about writing all that information on the bill of lading. And said, you got to sign a new bill. I don't need you to put all that on. I just need you to sign your name. And I said, well, I don't haul anything unless my company name is on the bill of lading. And he said, well, this was brokered through X, Y, and Z brokerage. That's the trucking company that's on the bill of lading. Obviously, they didn't know or understand the significance of the carrier being listed on the bill of lading, and so I ended up having to back into the dock, and hey, you can take the freight off my truck because I'm not signing unless I'm signing it the way that I want to sign it. That's just something that, from my experience and doing this podcast, reading Hank's books and things of that nature, always make sure that your carrier is the carrier of record on the bill of lading. And
the broker should never be the carrier of record on the bill of lading.
If they have a problem with that, don't even bother to haul the freight. And now that's a little bit easier because of the way I run my business. That was a little bit of an easier decision for me. But you got some people that are under the stress, financial stress of I gotta keep going. I can't afford to make these type of decisions because I gotta keep loads on the truck. I gotta keep money coming in. The financial pressure of being able to keep the wheels turning with some kind of revenue on the truck is really tremendous. And sometimes people get bullied into well, hopefully nothing happens, and we just kind of go with it, or wing in a prayer. And I've never been that lucky. It's not a problem until it's a problem, and I'm always seen to be the person that I just have buzzard luck. Can't kill nothing, won't nothing die.
Well, Hank calls them the two truck Charlies in this part of it, and
they're the backbone of America.
And unfortunately, you're absolutely right. And this is the pressure, and this goes back years. I mean, how can someone with a big stick push it down to someone less of that because of that? It's not right. It's not fair. This is why they put that anti-indemnification contract laws in place, trying to take rid of some of that kind of abuse. And the funny thing about it, Rico, what I just described to you has always been in state law involving contractors, general contractors, and subcontractors. It just never applied to trucking part of it. And so this is what ATA tried to do back to those contracts that I referred to here. But they got to decide what their worth is as a business and a person, Rico, and have the financial strength to step back and make those choices. Because I worry about that trucker with the times, Chuck, you mentioned the fuel costs and all that, where they're going to be a year from now if they don't sustain this part and be able to address it and offer the services to their shippers that those shippers willing to pay that. This is the pressure for these smaller motor carriers. As John said, a lot of them have said, I'm not going to operate myself. I'm going to join a motor carrier. And right this minute, that is a optimal way out because that, if you look at the rates, and you know, and you don't talk about it here on your Rocco, you talk about the spot rates, not the contract rates. But they flipped up a little bit. The contract rates are going up. That means the larger trucking companies who can provide the services either with own trucks or operators is getting more per mile than you can on the spot market.
Right.
So now they might be able to now affiliate with a bigger truck company, and the bigger trucking company is looking for trucks and drivers. We know that part of it here because they got more loads here. And so that's a way to get out of this dilemma where we are right now. And a lot of those have built into those contracts fuel surcharges. Spot rates don't have fuel surcharges in it, but 90% of the contracts that the shipper is signing with the motor carrier has fuel surcharges built into them.
All inclusive.
Gives some relief in here. And what the manufacturers have found out that they need consistent freight to be hauled. And the only way to do that is with fleets who have enough trucks to guarantee that hauling. And so the agreement is you provide us so much trucks, we'll provide you so much dollars, and we'll provide you so many loads. And so I think we're going to see a movement in that area away from the spot market and a movement from these truckers who thought they could live on their own with one truck with new authority saying, I can't do it anymore. And now affiliate with these larger ones who have more loads than they have trucks.
I don't know much, but I know that the report Tommy referenced a few minutes ago about 35,000 MC numbers assigned as a record over a 12-month period, and that was about a year and a half ago to 6 months ago.
Right.
I can guarantee you that the number of MC numbers assigned over the next 12 months will be a fraction of that.
Oh yeah,
because I mean, it doesn't take a rocket scientist to figure that today, if you were going to prognosticate, the amount of 2 truck Charlies is going to decrease substantially as independent entities over the next 12 months. They'll go under lease.
It'll be the ones, you're right on the money there, John. And it will be the ones that are new at it, because you talk to some of these people. I talked to one today, and we were talking about him doing some work, and he said, well, give me the price. I said, no, for this one, this is contract work. You have to give me your price. And the guy said, well, I don't know what to charge you. I said, well, I don't know what your costs are. I don't know what you pay for insurance. I don't know what you pay drivers. Those are your costs. I said, imagine going into a restaurant and the waiter says, you can have a steak. Tell me what you're going to pay me for it. It's the same thing. And this is very typical of new entrants into the trucking industry, not knowing the cost. Yes, the last couple of years it's been a bonanza. I have never seen people make as much money as what they made up until about 3 months ago, 4 months ago.
Well, Chuck, and there's another anomaly here because there's a pressure that even goes beyond the 2 truck Charlies. Some of these smaller motor carriers, 15, 20, 30 trucks, 50 trucks, they're suffering that. And what they're doing is selling their company to these big shippers. I mean, these big motor carriers. And the reason selling the company, the big motor carriers want them not for their business, but for their trucks and their drivers.
That's right.
And so we got more mergers or acquisitions than ever before trying to buy capacity because these larger fleets have the relationship with the shippers, the smaller ones do not. And those smaller truckers now is looking at, well, my truck's worth twice as much as what I thought it was. So this is the time to get out. Just like you probably have today in Florida, I'd like to sell my house in Fort Myers because I can make a lot of money on it. The problem is I can't find somewhere else to live any cheaper. And this is what we're dealing now, part of it. And so if they want to retire, that's great retirement.
Once again, if I had a 25 truck fleet where I needed to get out from underneath whatever and needed to sell it, I'd try to sell it right now, because what's going to happen 6 months from now, as the economy slows, the demand for freight's going to drop. And then as the supply of new equipment catches up and surpasses the demand, the value of the equipment is going to drop like a rock compared to what it is right now. So, I mean, there's a time to buy and a time to sell. There's a time to get in. There's a time to get out. And, as they write the history of 2022, this is going to be the year where all those things were true at a particular point in time.
Well,
I absolutely agree, because as we all know, the Fed is raising interest rates. They just raised the interest rates, 0.75 percentage points, which
Right.
means that that's going to make the availability of money kind of get a little bit more tighter. The criteria to get money is going to get a little bit more stricter, and now things are definitely, they're doing this to try to help slow down inflation, but we kind of already went off the rails, so to speak, a little bit. They trying to keep the train on the rails, but
well, you know
I
what,
think-
guys? Unfortunately, fuel is really the hot coal, the hot embers that stoke all this, because no matter what, it's fuel creates the inflation, because it costs so much to do, like for groceries, it costs so much for for manufacturers. If they can get parts, now all of a sudden they have to pay some of that percentage of that in excess fuel costs. Everybody's paying it. And even John Q. Public, he's got to spend so much money for his gasoline to put gas in his minivan to drive his kids to school and go to work. All of a sudden, that money is, that is allocated for other things, is going to fill up his car with gas. And if he's living in a northern climate, it's for heating his home, all sorts of things like that. So it's really stoking inflation.
Yeah, I think, and when you look at what John just put up, there is a difference, though, Chuck, is that everybody concerns fuel, and fuel is an international problem, and it's a problem here. Truck value inflation is driven totally by supply problem, because the reason those used trucks are so valued is because you cannot buy a new truck. Once the chip market happens and all that, then that's going to back down, where I don't think the fuel cost is going to go down as quick as the value of trucks, just because of the availability. Once the availability of new trucks there, these trucking companies got enough cash to go buy those trucks. In fact, they're hungry to buy them. They're doing these used ones and all just as a stop, just to keep their trucks running.
A guy that owned several Freightliner dealerships that I knew personally put it this way. He said, when our sales of new equipment go down, it's not all that bad, because here's the fact. If somebody didn't buy a truck today, they're going to buy one at a certain point in time. So what's happening to the equipment that's on the road, that's been on the road for too long, right? Because we can't get a new one. So by the time the new ones, that goes away. Look at the Wall Street Journal last week. And look what it said. It was last Friday, front page. Retailers are getting ready to slash price high because all the electronic 2 years, they ordered the hell out of them. And now they're there, and the demand is dropping like a rock, because people are not going to spend that money. They're putting it on the gas in their car.
Exactly.
So the same thing is going to occur when what's going to happen is you got the supply is going to catch up with of the new units, and the demand's going to go down. Then the value of the old equipment on the road will drop precipitously. It will drop like it did in 2010, where the size of the freight market and the demand for freight dropped, the perfect storm in the other direction. We could actually face a good portion of that in the last part of this year.
Oh yeah. Well, our tailwinds that we've had are going to turn into our headwinds. That's what I think is going to happen, because what will happen is the big guys, the mega carriers, Hunt, Schneider, Swift, all those guys, they've got orders in for trucks. They will get their trucks first, because the manufacturers love dealing with them, because they take thousands of trucks at a time. They're all spec'd the same way. They're pretty easy built. So they're going to look at, and those are big customers, and they'll look after them first. So they're going to dump finally, as they take delivery of the new trucks, they're going to be dumping all their used trucks that they've been holding on to for 5 years instead of 3 on the street at the same time. So that just substantiates what you just said.
That last part of your statement is the most important part.
Yeah.
Yeah. old. They're worn out.
Yeah, those things have. A lot of them have 750,000 miles on them. So those motors are due to be rebuilt, which is in this market, nobody can afford to do that.
Question: we talking about
Don't
age
have a
of vehicles
mechanic
now.
knows how to rebuild it.
We talking about age of vehicles now. A burning question is always we've kind of been dealing around this, and I'm curious to know from you guys from the insurance perspective. You guys have your pulse on the insurance industry. When it comes to older vehicles, the older vehicles, say 1980s, you got some 1980s, even some 70s equipment still out here on the road. Is there going to be a point in time where the owners of that equipment are not going to be able to get them insured to be able to pull freight? I'm pretty sure that there's a market out there that they probably will still be able to find insurance, but will it still be eligible for commercial insurance to be able to run up and down the highway? Is there any kind of talk like that that's kind of coming down the pike or in the insurance circles?
From an underwriting perspective, there's no defense of insuring equipment that's too old to be fit to be on the road, but is on the road. And that's where the non-voluntary market, the capes, the reinsurance facilities, the stopgaps that are operated by the various states should come into play. That's the risk that should not be able to buy insurance voluntarily. And frankly, technology today allows almost every insurer of trucks to see the VINs, so therefore the years and makes and models of the equipment that's on the road. It's harder to hide old equipment from underwriters than it used to be. Further, there's certain states, California as an example, that have said if you come into this state, the equipment can't be older than X. Right. The trailers, the refrigerated trailers, an example. And so, is there old equipment, really old equipment? You know what the biggest problem is? It can't stop. The brakes are horrible. The older equipment, the stopping distances are so bad, yet we don't do anything in the insurance industry to discriminate or to reward based upon the quality of brakes. If you had to think about it, that might be the way to rate equipment that's traveling the same distance anyway. You should rate based upon where, how much the truck rolls, how fast it goes, but how quickly can it stop?
Rocco, another one, the reason you have here is that you have this ELD situation where the truck's older than this part of it. And just from a suspicious underwriting, the only reason doing that is to avoid hours of service to run the truck harder. Right. And so that's the mentality of underwriters for these older trucks, if that's the reason. And you take an old truck like the one Chuck just bought that he repurposed his own, and all that, and all the chrome and all that, with a picture and well maintained, there would be maybe a market for it, for those kind of things. But you're being suspicious of other ones.
The most common answer for old equipment is there's a detailed underwriting process that has to be it's almost on a stop to acceptance with the insurers that I know. Anyway. Right. Somebody would have to be ignorant is the answer to the question. Ignorance is what you're looking for if you've got bad old equipment.
But the other thing,
I was just curious whether with people that own that equipment, will they still be able to keep the insurance on their trucks if they, what I'm saying? There's a lot of people that for whatever reason, they decide they want to run older equipment. They just love it, or whatever the reason may be.
Rico, because there's two things. Because insurance is mandatory,
right?
The state has to provide a mechanism, no matter how bad the risk is, to provide insurance to them. So the answer is yes, they'll be able to have insurance at a price for liability.
But period. It should be the state, not a voluntary risk.
Right, not
taker.
a voluntary. It's the pool there. Just like work comp. There's a pool for work comp because it's mandatory, and you cannot have a law that says you have to have insurance without some mechanism for no matter how bad you are to buy the insurance. And that's the state mechanism. That's part. Typically, and there's rare exceptions to this, North Carolina was one for a long time, where the involuntary market, residual market, is cheaper than the voluntary market. There's corrections that's not the way it's supposed to work, but there are a few situations where that happened, and North Carolina was better than some up in the Northeast now with that situation today. But yes, they'll be able to get insurance. Now, physical damage, different story. They might not be able to get physical damage, Rocco, but the liability they can buy, because the assigned risk only provides liability coverage.
Well, I'm looking at the time, gentlemen. We done blew that hour straight out
Fastest
of the
hour of my week.
So, with that being said, I would like to give you two gentlemen an opportunity. Tell everybody once again where they can find you if they got questions. I know you guys don't. Tommy says it all the time. He's not selling you anything. We just got information to give you. So, how can people get in contact with you and find you, and anything else you'd like to leave us with before we get out of here?
Well, since John just joined us as the executive officer here, he'll tell you this stuff other than me, because we're there at the same time and the same address. John, tell him.
Tommy is the pickle man. He's the kingpin. And Tommy Rook knows more about trucking insurance than everybody else I know put together. Tommy Rook formed a group 10 years ago, the Motor Carrier Insurance Education Foundation, mcief.org. And on our website, there is Ask Tommy. And so any question relating to trucking insurance, if it's asked of our entity, and you also can email Tommy, and his email address is out there, you can ask me, you can do it on LinkedIn. You can say, I have a coverage question. I'm a trucker, whatever. But the point is, we'll answer the question. And if he doesn't know the answer, he's going to call you if he thinks you know the answer. So the point is, he knows you two guys. So if he thinks you know the answer and he doesn't know it, you don't be surprised if you're not answering Tommy's
I'd be honored.
Well, thanks, guys, for having us, and just let them know that they got to do business with agents who know their business.
100%.
This part of it, and the people who have listened to us for 48 hours know something about a truck.
Well, not just agencies, but agencies that know the trucking industry. That is paramount.
Right.
It is.
Well, gentlemen, we want to thank you again for taking time out of your schedule to come on the show and join us. We are definitely appreciative of you doing so, being so gracious with your time. We appreciate it. Sorry we wasn't able to get in on that free meal that you guys gave out tonight. But,
y'all be safe, guys. Thank you. I'll see y'all again anytime.
Thanks, John, Tommy. Thank you very much. God bless.
Well, Chuck.
Yeah, if anybody needs me, anybody needs some information, anybody wants a hand getting set up with traffics, or if you're having some problems in your business, or you have some questions, feel free to reach out to me. These days, best way to get me, send me an email. It's just chuck@traffics.com. Or you can send me a private message at Chuck Snow, CEO on Instagram. And with that, Rico, I'll let you back into a hole for another week.
Absolutely. Well, ladies and gentlemen, we want to thank you for taking time out of your schedule to join us. You could have been anywhere else in the world, but you're here with us on the Racing Lanes podcast, and we're always eternally grateful for you doing so. Check out our YouTube channel. Like, share, and subscribe on the YouTube channel. We're trying to grow that platform. We're trying to grow all of these different platforms that we're working on with this new technology coming to transitioning the podcast over into the video format. So any support that you can give us, we greatly appreciate you doing so. With that being said, ladies and gentlemen, we want you guys to stay safe out there, stay healthy, keep it in between the mustard and the mayonnaise, and God willing, we'll talk at you same time, same place next week. God bless you and good night.
Catch you on the flip-flop. Good night. God bless.
Good night.